Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a brief look at the disclaimers that I need to show you, I'll just run through the key objectives of this webinar. Markets, we think, are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals, can be short-term themes that increase or decrease in importance over time. We also try to break down all the market jargon and complexities that we read about in the market. So if you do have any questions, please do ask them along the way and write them in the box. And I'll hope to answer them as we go, or at least after the webinar finishes. Okay, it's an action-packed week, as we know. We'll run through how markets are shaping up currently. We'll look at stocks and of course it's a big earnings week for results out of the US and Europe as well. We'll then briefly recap actually UK CPI data and look at cable, so sterling against the dollar, important moves there potentially, before then getting on obviously to the main events of this week, which is the Fed later today, then the ECB meeting within a few hours tomorrow really, and then the BOJ meeting which finishes the week on Friday morning UK time. So a lot to look forward to. We'll look at the majors concerning or attached to those meetings, of course, so euro dollar, dollar yen, and we'll look at the DXY as well, attached to obviously the Fed meeting. Markets currently then shaping up. Let me just check out where we are currently before I get to that, and the UK CPI. Yeah, markets generally well. European bourses mostly lower, exception of Spain and Italy, which have been supported by domestic earnings releases actually from a couple of the banks, Santander and UniCredit. There's a lack really, of course, of fresh fundamental drivers really in the run-up, of course, to these big G3 central bank meetings that we get over the next few days, next few hours really. Stateside futures, US futures sort of modestly in the red after sort of mixed results from Microsoft and Alphabet after the close last night. They were Microsoft falling down around just under 4% actually in Frankfurt after hours on soft guidance, as growth in Azure, its cloud services business, disappointed, even though it beat earnings estimates. Google's parent, on the other hand, that's surging around, yeah, nearly 7%, I think 6.9% at the moment in Frankfurt after the close, as it beat on the top and bottom line, surpassing analyst expectations. The DXY trades tentatively lower. Yeah, very tentatively lower, actually, modestly in the red. Clock ticks down to the Fed tonight. Of course, there are some relative strength actually in the yen, interestingly enough. Markets still second guessing what will happen ahead of the Friday meeting of the Bank of Japan, and Aussie is now yeah, down over 0.5%, really on softer CPI data overnight, potentially underpinning the RBA meeting next week and another pause by them. Interestingly, crude benchmarks, they're holding recent gains after Monday's big move higher on the back of that initial readout from China's Politburo and potentially more stimulus to come. Gold following the dollar really, so the dollar slightly softer, gold slightly higher then. But nothing too major to talk about. Okay, let's just look now at, just bear with me 1 second. I'll just pull up S&P chart, which is here, of course. Hopefully you can see that. Yep, there. Just bear with me 1 second, sorry. Okay, yeah, so stocks in general, of course, we have a massive earnings results week This week, really, 166 S&P 500 companies, I think, are reporting, including 12 Dow Jones Industrial Average components. That's according to FactSet. Of course, all combined, then these results will offer essentially a more clearer picture of the pace of the economy and the financial health of the American consumer, as well as overall as economic growth slows. Companies, though, do continue to hire. We've seen that hot job market really, and considering where we are in the cycle, really quite healthy job gains still. The swell of pandemic era inflation kind of appears now to be subsiding, and we're getting this disinflation process, much hoped for, and seeing that in US numbers especially. Meanwhile, of course, Fed officials recently signaled at least one more rate increase is expected, and we'll talk about that in more detail. As for companies, then Procter & Gamble, Coca-Cola, among the household names set to report their quarterly results in the next few days now, offering more insight into consumer and corporate spending as inflation cools. Others scheduled to issue updates include energy heavyweights, or the heavyweight ExxonMobil. That's on Friday, I think. Payment firm MasterCard is later today. And then we have restaurant operators, Chipotle, Mexican Grill, and McDonald's. But for sure, probably a lot of focus with retail side especially, is on Meta tonight. So Facebook's owner. Slight sense of caution really after those Tesla and Netflix earnings, and then that sort of softer guidance by Microsoft overnight. For Meta, it's scheduled to report, 8% year-on-year revenue boost, 24% year-on-year surge in EPS. That's at $3.06. Key will be the recovery still of the US online advertising business, which of course is a major contributor to Meta's growth. And probably one possible downside, one concern, is Meta's comparatively less developed AI advancements that we're hearing about. Investors will probably closely listen to the management call to get any insights into any possible new developments in this area. And given then the wider picture, really, the significance of big tech companies in the broader equity market, we've talked about that over the last few months, and the narrow breadth that we have seen, although that is slightly broadening out, especially with the Dow outperformance, but major significance attached to big tech results. Of course, AI mania fueling the gains that we have seen, of course, in the first half of US indices. The Nasdaq, of course, S&P 500, the wider benchmark as well, considerably higher this year, confounding most experts, economists, strategists, confounding them, and most expectations. Yes, as I say, driven by AI. So for Meta, certainly any hints around that, any new insights will be keenly watched and rewarded, or I would say punished as well, potentially. Let's just look at the S&P then 500. We can see this on the weekly chart, really nice uptrend, having broken really sort of 4,200 or so. We highlighted that over the last few weeks. Key nice breakout from that sort of upside. We capped it, 4,200 had capped the upside, and then a push higher, really strong close higher at the end of May, start of June, and then a really nice positive uptrend. We're now getting into slightly overbought territory. You can see there on the RSI, touch above 70, so slightly overbought. And I've still kept in these fib levels here, so we're pushed up through slightly the slightly minor fib level, 78.6. This is of the 2022 decline, you can see. So we're up above that. I'm probably aiming now for that March 2022 high at 46.37. You can see there, before possibly then getting up to 4,700 and then the high of 48.18. If we do slow up and potentially there is a pullback in play as we get slightly more overbought. Doesn't mean we can't get overbought over a considerable amount of time, as you can see from back here when we just pushed higher. But if we do, then yeah, 45.34 might be a sort of level of support, and then probably the breakout level for us around where are we? 44.60, 44.60. Yeah, 58, 44.60 or so, around there. 56 actually, so 44, 58, 56 is a sort of breakout level of support you can see there. That's on the weekly. Let's just look at the daily. You can see a nice positive uptrend, 50-day moving average really supporting the push higher. So that comes down actually at 44.67. So yeah, slightly above that breakout level that you can see there as some support for the S&P if we do push lower. Let's just look at the Nasdaq as well. Obviously very positive uptrend, you can see there on the weekly chart. We've pushed above actually now those previous highs from March last year at 15,265, so that'll be a level of support for us, which sort of tallies with that breakout level there. You can see otherwise the recent high at 15,932 is important, before then possibly a move up towards 16,000. Dow, really interesting, consecutive days of gains. Yeah, on the day you can see, I think it's 12 now, 12 consecutive days of gains, marginally higher yesterday, 0.08% you can see. But for us, if we just go back to the weekly, we've highlighted this 34,281 level being strong resistance. We tried to break it on numerous occasions, numerous weeks previously, and then we did say the longer it takes to not push through, then if we do, it will be a strong move higher, and that's what we've certainly seen on the daily. You can see there all those consecutive days of gains, and now we're pushing up towards, yeah, this this swing high from April again at 35,492, closed just below there. Really interesting. If we can continue this bullish run, then certainly we're sort of up to the sort of 36, 37,000 or so. We're not overbought on the weekly. Daily we are overbought. You can see 74.16 the daily RSI, so possible level of profit taking, or indeed just a move lower on the Dow. Really interesting move there though, considering how tech had been pushing the broader S&P 500 higher, and now some of the energy stocks, financial stocks, after results especially, moving and pushing the Dow 30 higher. Okay, let's now go to just a brief recap of last week's main data, which was the UK CPI data for us. Price growth slowed more sharply than forecast. Really big relief to the Bank of England and also UK government, actually, who've sort of put it on the line that they hope to see a halving in inflation by the end of the year. I think inflation, when they said that, was around 10.5% or so. So they want to see headline inflation, that is, moving down towards 5%. Bank of England definitely keen to see that. Headline prices rose 0.1% on the month, 7.9% on the year. That's down from 8.7% in May, and beat also, or missed, if you like, consensus expectations for a rise of 8.2%. Really big contributor in the headline, as it is across the globe, really, is the transport segment, declining energy prices, petrol prices moving lower, and especially that year-on-year drop from the spike previously 12 months ago. Interesting whether we do get big moves lower now going forward because of that comparison, annual comparison. Those base effects may not be as pronounced as we have seen. Take that on board, or we're certainly taking that on board. As for core, well, on the chart, of course, you can see the blue line there, and headline prices moving lower, and then the core, which is the lighter blue line, really welcome dip as well, expected to remain at 7.1%, dip below 7% to 6.9%. And the Bank of England, they're mostly focused on services inflation, and there was good news there too, actually. So a decline we saw from 7.4% to 7.2%, and that is contrary to Bank of England's expectations, their own expectations actually. So good news there. We've just got another chart which just shows you a comparison actually between UK, US and the Eurozone. UK still elevated, you can see the blue line, the dark blue line there, but coming lower. Then you have the US at 4.8% or so. So this is the core prices. So they exclude food and energy. US 4.8%. And the Eurozone 5.5% or so. So yes, still a gap between the UK and the US and Eurozone, but that gap is narrowing. Of course, some economists talking about UK having been a stagflation nation, so slowing growth and still rising inflation, but hopefully now that has turned a corner. Of course, one report doesn't make a trend, but yes, there are reasons to believe it could be moving lower now. Market reaction was obviously pretty strong, especially two-year bond yields. They moved down nearly 25 basis points on the day. That's basically markets repricing the more extreme Bank of England rate hike bets that we had seen. And if you remember, the terminal rate for expectations had closed in on sort of 6.4% in the UK. We're currently at 5%, remember. So markets were expecting a load more rate hikes, but they've reined that in now. And more crucially for the Bank of England meeting next week, prices now, swaps actually, that's bond markets really pricing in around 33 basis points for the meeting next week. So that's a bit more than a 25 basis point hike. Terminal rate now around 5.8%, again from that sort of 6.4%. So big adjustment. Really the question now is whether that softening report tilts the balance firmly in favor of that 25 basis point hike. Markets, as I say, still sort of where are we? About sort of 70-30, I'd say, to a 25 basis point hike as opposed to a 50 basis point hike. 50 basis point hike was nailed in before the CPI report. So really interesting to see what happens, obviously, in the Bank of England meeting next week. If we just look at a cable chart, then just bear with me while I pull up. Oh, sorry, 1 second. Bear with me while I pull up the cable chart, which I can't find at the moment. Sorry, bear with me. Yeah, here's cable, which you can see now. Hopefully, yes, you can. Sorry about that. So, yeah, big moves in cable with those readjustment in the Bank of England rate expectations. You can see the high there last, a week Friday, actually 131.42, but we were overbought. You can see there on the RSI. I also put in some Keltner channels, actually similar to sort of Bollinger bands, slightly different. We were pushing beyond those bands, the upper band. So a pullback was expected. Quite a sharp pullback, though. Quite a few consecutive days of selling. But the 50-day moving average, that's that blue line there, which has acted as sort of okay support really in previous months. That's a 128.59, so that has acted as support again. Also, we like this June high, which capped the upside briefly later on in June and has acted now as support. That's a 128.48. Below there, then you do have this sort of rising trend line, which is held as support. You can see quite nicely. Whereas that's probably around, where are we? This fib level here around 127.64. So that's just below really. If we do lose that low from Monday, which is at 127.97. Interesting, the move yesterday I thought was interesting, kind of reasoning, no proper reasoning why, not bullish really sterling, but it was on the back of the euro dollar falling sharply, the euro falling sharply, euro sterling, if you look here, that big move down, so that helped sterling against the dollar yesterday. Going forward, there's not a lot of UK data this week, so the dollar leg will have a big impact, of course, on cable. Whether we do get sort of more hawkish Powell, whether that then helps UK rates as well and bolster those, will be interesting for cable, although the dollar will be probably the main driver. Okay, let's move on to obviously the main event for this week, which is the Fed. First of all, if you just bear with me, I'll just pull up the graphic that we like to put out there. Hopefully you can see that, which is all the main numbers that we look at, that probably policymakers look at as well, traders look at for sure, to do with the Fed. They're expected, of course, to hike rates by 25 basis points. That's nailed on now by bond markets. And the key question really is around whether this will be the last rate hike of this cycle. Remember, just stepping back, after 10 consecutive interest rate hikes over the last 15 months, the Fed left the target rate unchanged at 5 to 5.25% in June. However, the Fed did characterize this as a slowing in the pace of rate hikes rather than an actual pause. And then they had 2 further hikes signaled for the second half of this year in the dot plot, so in their individual forecast projections. Since then, data kind of remains slightly mixed, where inflation trends, of course, taking all the headlines, softening. That disinflation process is in play. And you've had, as you can see here, 3% headline inflation, 4.8% core, so still sticky, still way above the 2% target, remember, but those monthly gains were really interesting for markets. 0.2% monthly gains, which is what is precisely needed, is actually below that if you round it down, but 0.2% what is needed to bring inflation through the months down to their target. Otherwise, we still have, though, this tight labour market. 209 was the recent non-farm payroll, so below the forecast 230. And actually, as I've said there, the first time in 40 months, consensus has overestimated, but still healthy job gains. 200,000 in this part of the cycle, as I've said before, is still healthy. So that is what the Fed has to sort of take into consideration. Commentary from officials has kind of obviously broadly indicated they feel the need to hike again, and really now consensus, it's all about consensus. They see the accompanying press conference acknowledging those encouraging signs on inflation, but also a desire not to take any chances that could allow it to re-accelerate. And that is certainly bearing in mind as well the false starts that we have seen really in the disinflation process before. So kind of consensus thinking, the Fed officials will be wary of that. They want to keep the door open to further policy tightening later in the year. Potentially, they might signal, Powell might signal in the press conference, because there's no new dot plots till December, so that he might signal this hike and then a possible pause. If he doesn't, and the September meeting is live, or he talks about that being live, then that is probably a more hawkish signal than consensus is expecting. That should help the dollar, support the dollar going forward, but potentially then near term, the market might look at it as being very close to the end of this tightening cycle. Let's not forget, before that mid-September meeting, there's no meeting in August. We do then get a couple of inflation prints and also 2 more non-farm payroll reports, which are obviously start of August, start of September. So really interesting to see what will happen going forward. I do have in there as well that sort of 1 in 3 chance of another 25 basis point hike by the November meeting. Well, that goes against the dot plot of course that I've just mentioned. So we'll be interested in whether those odds, which can increase substantially, whether they push higher towards that dot plot if Chair Powell sort of pushes back against market pricing, and also against some of those rate cuts that you can see there's 115 basis points of rate cuts priced in by the end of next year, whether he pushes back against that as well, because he thinks it's too early to talk about that currently. Let's now look at the dollar, the DXY chart. Just bear with me 1 second. So the dollar chart, which is obviously, well, I'm sure you know. If you don't know, it is a basket of currencies of six big trading partners of the US, with the euro being by far the biggest weighting in this DXY, around 56-57% or so. So always bear that in mind when we look at the dollar, the DXY chart, sorry, although obviously it is the most widely quoted when we talk about the dollar generally. Interesting sort of corrective mode, quite nicely, a few consecutive days of gains up until yesterday, then that 50-day moving average cap the upside, you can see at 101.60, and we're just sort of rolling over now probably, but of course we have all these major risk events to come. It's interesting, market positioning, we look at that quite closely, and the latest data from FX futures markets in Chicago suggests that asset managers are running their largest short dollar position on record when aggregating their positioning across 8 FX futures contracts. So that's something to bear in mind. And then otherwise, as always, the dollar story is driven by sort of pull factors of the US versus the rest of the world. So if Powell mentions a live September meeting, that will be hawkish and help the dollar short term at least. If he says the dot plot is valid still, and that means and it implies another 25 basis point rate hike on top of this one later today, then also that would support the dollar, you would think. Although that might only be short term, because of the challenges potentially facing the US further down the road. I think it's interesting as well. We have, well, you've got the levels in there really. Upside cap by 101.60, and well, I've drawn in some fib levels of this July decline. So the halfway point is at 101.57. Couldn't quite get back up to that this recovery and bounce. So probably that caps the upside as well. Next level of support 101.10. You can see there the fib level. Otherwise, sort of 100.82, which is a long-term support level, which we broke and then put above again. So interesting points there. Otherwise, also mention the Fed's whisperer, if you like, in chief, Wall Street Journal's Nick Timiraos. He had a recent article entitled "Why the Fed Isn't Ready to Declare Victory on Inflation." And he said officials remained concerned about whether prices, whether wages actually and price growth can slow enough without an economic downturn. So something to bear in mind probably there as well when trading the dollar. Okay, let's move on to the ECB meeting. Just bear with me 1 second. While I get up a graphic again, similar to what we've just looked at. Actually, before we get to that, you can just see this pricing laid out actually. So yeah, we push up to sort of, where do we push up to? Sorry, we push up to 5.25 to 5.5% with this 25 basis point hike. And then from then, potentially we're moving lower, and that's what the market thinks, as I said. And then you've got this bunch of rate cuts through to the end of 2020, 24, 24, sorry, bringing rates down closer to 4% by the end of next year. That's the current market pricing. Slightly different though, as I've said, from what the Fed dot plot is proposing, certainly for, well, through 2023. Okay, next moving on to the ECB meeting on Thursday. Again, a load of numbers here. Hopefully these help your understanding of what to look out for or what to look at, and then determine what the ECB will do. As judged by pricing, similar to the Fed, nailed on 25 basis point hike. So it's not really about that, although that takes the deposit rate up to 3.75%. As I say, not really about that. The decision to move on rates, if we step back, yeah, that decision is based on the Governing Council's view that inflation is projected to remain too high for too long. That prompted President Lagarde previously to declare at the June meeting that there is still more ground to cover, and the ECB is not done on rate hikes. So she pretty much telegraphed this 25 basis point hike, as I've said. We've had a cooling in inflation, headline inflation cooling to 5.5% from 6.1%. And then, as I've mentioned, the super core metric actually ticked higher to 5.5% from 5.3%. So with this in mind, and obviously officials, numerous officials flagging this hike, instead, of course, the focus now is on any accompanying guidance or hints about what tightening, if any, will be delivered from September onwards. Again, no August ECB meeting, the next one in September. Interestingly, Bloomberg suggested the toughest challenge for President Lagarde and the Governing Council will be how to keep that September meeting open by avoiding sort of strong signals of another hike or another pause. Probably unlikely to repeat the strong guidance that we've had following meetings over the last few meetings, actually, and really then President Lagarde will try to revert to data dependency and a meeting by meeting approach. Interesting, we have had a more moderate tone as well by some of the ECB's most prominent hawks lately. Member Klaus Knott refrained from putting actually a September hike on the table by suggesting that rate increases beyond July are possible but not a certainty. So markets really did focus on those comments from a well-known hawk that he is. And then we have really sort of ever deteriorating Eurozone economic activity and data. And we've had the PMIs earlier this week. You can see the 48.9 number was the composites, so that has manufacturing and services sector combined. That hit an 8-month low. We also had the IFO German business survey, which hit lows as well and moved below expectations. And then we had the ECB bank lending survey, which pointed to tightening conditions and tightening lending conditions and borrowing. So potentially that is economic data which is worsening further down the road, and the ECB will pay strong attention to. Market pricing for September, you can see there. So the next meeting is around a 50-50 or so. So really interesting. Again, that has the capacity to move, of course, either way. So price in a hike if President Lagarde says that work is not done yet and still hints of another hike in September, or if definite data dependent sort of bias is confirmed and nothing is, we will not commit to anything beyond this meeting, then potentially that 50-50 moves lower, of course. For the euro, just bear with me, I'll pull up a chart again. Euro dollar chart here, of course. Really interesting then. Yes, obviously with the Fed risk event as well, a few hours before, it's whether then we get the prospect of the ECB less than wholeheartedly possibly backing that idea of the follow-up rate hike in September. That would signal downside risk to euro dollar for sure. I think it's interesting. The options market, just to note, won't get into it in too much detail, but they're suggesting kind of not massive fireworks over the next 24 hours or so. So the options, you can price any sort of period, but the 24-hour trading period capturing both the Fed and the ECB decisions only sees around a 60 pip range in euro dollar. So yeah, interesting stuff to think about. Euro dollar anyway, yeah, move lower. You can see after that high from last week, last Tuesday, 112.75. Actually, if we just go to the weekly chart, just to pull up these long-term fib levels of this sort of 2021-2022 decline, 112.74 was a long-term fib level. We tapped it last week, but couldn't close above it, closed below, as well as that 200-week moving average, which is that thick black line at 111.83. We closed below that on the week, so a negative sign, of course, and then now we've rolled over. But interestingly, we're back to this level 110.32. We've had it in there over a load of previous months. You can see that was the high from early Feb, capped the upside pretty much in sort of April and May. We burst above it middle of this month, but then have rolled back to it, but that is offering support now. So 110.32, as well as then the blue line here is the 50-day moving average at 110.41. That will be initial support. If we bust lower, then we go back to sort of 110 as a round number, and then the next fib level, let's just check, is sort of below that at 109.42. That's the halfway point. So not a genuine fib level really, but a halfway point always looked at of this decline. Euro dollar, yeah, options market is not thinking there will be massive moves, but yes, we will see. Okay, let's wrap up with a look at the BOJ meeting finally. We've got a chart in here. We haven't got a graphic, actually. We've got a chart just showing you how high inflation is at the moment, 4-decade highs, but there are question marks around that. Yeah, Bank of Japan, obviously the outlier in the pack, really. First tightening move in the cycle is still awaited, of course. Expectations for a July tweak were running high until just last week. A load of comments we've had since then, pouring cold water really by saying that the Bank of Japan sees little need to tweak yield curve control at the moment, and certainly because the 10-year yield is trading stably within the 0.5% cap. Of course, headline inflation, this chart shows you, has remained well above expectations and the 2% target. So potentially, and there are numerous press reports about this, there are expectations that the Bank of Japan will raise the inflation forecast for this year above that 2% target, possibly around 2.5% for this year. So that will be interesting and could possibly pave the way then for further policy normalization through the year. But the rhetoric from the central bank continues to suggest a lack of urgency to tweak policy. Governor Ueda himself recently stated there is still some distance to go before sustainably achieving the 2% inflation target. And the bank has been patiently maintaining easy policy, while he added, notably, unless the assumption on the need to sustainably achieve the 2% target changes, the narrative on monetary policy will not change. And interestingly, he kind of sees inflation really, well, stating responding to an inflation undershoot after a premature rate hike is more difficult than responding to an overshoot. And he kind of sees this this sharp rise in the Japanese inflation being driven by external factors more than domestic demand and domestic factors. Really interesting then, because there's has been so much speculation about the Bank of Japan tweaking at least its yield curve control band, which it did in December, and that caused ructions, of course, about potential policy normalization from there. We haven't had it yet. We've had mixed data really with otherwise, apart from this inflation data, Japanese machinery orders contracted, but then we had the latest quarterly Tankan survey, mostly topped estimates, and really showed Japanese large manufacturers sentiment improving actually for the first time in 7 quarters. So interesting to see, obviously, what Governor Ueda, whether he sticks to what he's been saying recently, even in light of potentially higher forecasts in inflation for this year. Just bear with me, I'll just get up dollar yen just to check out, which is here, which hopefully you can see, of course. So really interesting. Obviously, we had the big move up towards 145. I got it there, the big thick dotted line. Really, that was an intervention level, or markets were on watch that the Japanese authorities would intervene at that level and push dollar yen lower. Which it did do anyway on really falling US CPI data really helped. And we've sort of moved lower towards, actually you can see the the thick black line there is the 200-day moving average. Interesting, capped the upside there, you can see previously in the year, and then possibly is acting as support, which we got close to middle of this month at 137.23. The 200-day moving average now moved lower, but potentially that will act as major support going forward. You've got the 50-day moving average that has acted as support and now potentially as resistance. That's at 141.52. So if we do move lower, then we've probably got these fib levels in here as well to look out for. 139.58, potentially a mark lower as well if we do see any move from the Bank of Japan or even, of course, the Fed. Okay, hopefully that's been of use to you guys. I don't see any questions at the moment. Really appreciate you logging on and spending the time, and hopefully that's proved useful. As I say, so much going on this week, and also next week as well, with the Bank of England as well as the RBA. So we'll be covering that in a couple of weeks' time, no doubt. Take care out there, and we'll speak to you next time.